Chapter 8 of Financial Accounting, we talk about long-term assets. So plant assets are the most common, and I always refer to those as what it says down at the bottom, property, plant, and equipment, or abbreviate that PPE. But our property, plant, and equipment are things that are tangible in nature, which means we can go out there and touch them and we can physically see them. They're used in our day-to-day operations, and they're expected to provide some sort of future benefit, whether it's sales or primarily sales or service that we can perform services. We can earn revenue from them. So basically, we have to determine what our cost is, and we will compute that cost. Again, it can have a variety of things in there, as you'll see as we go through the slides. Then we're going to allocate that cost out to the benefits to the periods that benefit from it. So again, it could go over the next 4 years or 7 years or whatever we estimate that useful life to be. Then once we get to the end of the useful life, what are we going to do with the asset? Is it just trash, or does it have some sort of salvage value? Could we trade it in? Could we sell it? So those are the things we have to consider. So the first one, our cost determination, obviously the purchase price is the most obvious, but we also have any and all costs that are necessary to get it to its intended use, to get it to its location and get it ready for its intended use. So that's kind of the key as you think about it. Am I getting it ready for its intended use? So with machinery and equipment, obviously the purchase price, the taxes that they're going to charge us on that purchase price, how are we going to get it to our facility or our business? There's going to be some sort of shipping and transportation charge. Do we have to pay for insurance while it's in transit? Then once it arrives, there's definitely going to be some sort of installation, kind of modifying it to getting it ready for what we want, testing it to verify that everything works. So these are all costs to get it ready for its intended use, and all of these would be what I say capitalized, which means we add those to the asset's cost. So if it's equipment that we're purchasing, all of these different things are going to go into that equipment value. So buildings, again, depending on if we're purchasing the building or if we're constructing the building. If we're constructing it, there could be a lot of costs that are going to get accumulated in there. The cost to go out and purchase an existing building would be easier, like what's the price you agreed upon in your purchase agreement. But then there'll be title fees and attorney fees and property taxes, maybe even past due property taxes. So all of these things are going to get added when we close on that building. And then did we pay a real estate broker? That also will get paid when we close on that building. So all of those things get totaled up in our closing statement, and we end up paying a higher price then for that building based on all those adjustments. Land improvements are things that go into the land and that cannot be removed without causing damage to that land. So parking lots, driveways, fences, landscaping, lighting systems, again, if they're elaborate and like in your parking lot and things like that. And those though get used up. So the reason we separate them from the land itself is because land does not get used up, and land we do not depreciate. Land improvements does get used up, and we well depreciate it, because parking lots don't last, driveways don't last, fences definitely don't last. Like your landscaping can last, but not necessarily. So those are all things that can get used up over time and have useful lives. Now, land, like I said, is not depreciable, but it too can have a lot of those same expenses that the building did. So you're going to have title, and you're going to have a purchase price. You're going to have a title company that gets you good title on that land. Property taxes, past due property taxes that you're assuming. There could be surveying phase that you choose so that you know exactly where your boundary lines are. Legal fees, and then again, real estate commissions. And most of these will all, again, be handled in closing. So you'll get a closing statement at the end that's going to be much more than the purchase price because of all those closing fees. Now, it is true that if you're going to buy an existing building and land, you're going to pay a lump sum purchase. So because you're a business and you're thinking, okay, I paid $90,000 and it's for land and a building, how do I break those out? So you can go through here and say, well, here's our appraisal. The building appraised at 60,000, the land appraised at 40. I didn't pay 100,000 for it though. I got a really good deal. I only paid 90,000. So then you look at it to say, okay, well, the building is worth 60%, the land is worth 40. So I'm going to use those percentages and multiply those then by the price that I paid, so that I'm allocating out that lump sum purchase, giving so much to the building and so much to the land. And you might think, is that necessary? But again, when we go back to the fact that land is not depreciated, it is necessary to properly add the correct value to the land and add the correct value to the asset that we're going to depreciate, which is the building. So then our depreciation, it's our way of taking that acquisition cost and charging it off to expense as we use that asset up or as time passes, one or the other. So what do we need to look at when we're computing our depreciation? The cost, which is what we've just talked about on those last few slides. At the end of its life, is there a trade-in value? Is there a resale value? And then what is its useful life? So we have three different methods: straight line, units of production, and the declining balance. Straight line is the most common and the easiest. And then units of production is not bad, but it's not necessarily harder. It's just more specific. Not all assets fit into that category as well. So straight line, we take our cost minus our salvage value and divide it by our useful life. So we're going to charge off to depreciation expense $1,800 each year on this particular asset. So as we do our adjusting entries, we debit depreciation expense $1,800 and we credit accumulated depreciation machinery $1,800. So then it's level all of the years, again, assuming you purchase it on January 1st, all of the years are going to be the exact same amount. And then we see it decreasing at the exact same amount on our balance sheet. And then when we get to the end of the useful life, what is left on the balance sheet is what we thought the trade-in value was or the residual value was. Then here they show you again just kind of how it's mapped out, how the accumulated depreciation grows, how the net book value decreases, just in a table form. The units of production method, you can see the top is the same. It's cost minus that salvage value. Our units of production, though, is now what we divide by instead of our useful life. So that would work well for like a car. You could do the miles, like how many miles do you think on the life of this car? How many miles did I drive? For equipment, you could do machine hours. How many hours do I think I'm going to be able to run this machine for versus how many hours I actually ran it? It's just like buildings and some of those other things. I mean, maybe even like computers. Those are a little harder to quantify into specific units. So some assets fit more accurately into this method. But then what we'll do is we'll come up with a cost per unit, and then we'll multiply it by however many units we used in that period to calculate our depreciation expense. So the top of it's $10,000 minus the $1,000 salvage value. So it's still $9,000 on the top. But now we're going to divide it by 36,000 shoes is what this one is. So then we're going to charge off 25 cents for each shoe that we produce. So we've got 25 cents times 7,000 shoes that were inspected. So $1,750 is going to be what we charge off to depreciation expense. But as you look at it, see, every year is going to be different because every year is based on your number of shoes that were inspected. So it can go up and go down. So then depreciation is not consistent, but you will still get to the end where if you've reached your total units, you've depreciated the full 9,000, and then what's left on your books is $1,000. Now, the declining balance method is a little more tricky. And what it does, though, is it enables companies to take more depreciation in the first years that they purchase the asset, which companies like because it saves them having to pay the IRS. So what we do is we figure out our straight line method. So our straight line method is 1 divided by the number of years in the useful life. So that gives us, if it's a 5-year useful life, 1 divided by 5 gives us 0.2 or 20%. The double declining is going to say, okay, we're going to take 2 times that. So 2 times the 20% says we're going to depreciate this at 40% a year. So if we have a $10,000 asset times 40%, our depreciation for the first full year is going to be $4,000. So that's obviously twice, actually more than twice of what the straight line was, because the straight line dealt with the residual value as well. Now this one, so how we go through it though, so that first year we take 4,000, which would bring our net book value then down to 6,000. So then 6,000 times 40% in year 2 will take another 2,400, which then brings our net book value down to 3,600. Multiply that by 40%. Our depreciation expense is 1,400, which takes our net book value down to 2,160. Multiply that by 40%. Depreciation expense for year 4 is $864. That brings our book value down to 1,296, but we don't then take that and multiply it by the 40%. If we took 1,296 times the 40%, we actually get $518. That would take it over our salvage value. So we look at the difference and say, okay, all we have left to depreciate is $296. So that final year, all we depreciate is what takes us down to our residual value or our salvage value. So then as we compare them, again, straight line is the easiest and it's just allocated straight across. Units of production go along more like with your use or your sales, and declining balance shoves everything up to those first years just so you have a tax savings. So here it shows you that most companies use straight line again because it is the easiest. But what we were assuming as we looked through those is that we bought the asset on January 1st. Well, that's really not always applicable, right? So we buy assets all different times of the year. So let's say we bought it on October 1st. We still calculate our straight line depreciation the same, but now we don't get to take a full year. We only get to take 3 months out of the year. So that's going to be $450 that we would take for that final quarter. Then as I said when I first started the chapter, I said if things get charged to equipment or building, I call those capital expenditures. So those are things that go to our long-term assets, our property, plant, and equipment, and they're going to provide benefits for us for more than the current year. So they're going to go into that asset account, they're on the balance sheet, we're going to depreciate them. If we decide, okay, we have put a ton of money into this plant, but all it is repairs and maintenance, then we've got to charge that off as expense. And they call that a revenue expenditure. It's going to go into an expense category and be reported on our income statement. So ordinary repairs are a revenue expense, and they, again, are just bringing it up to what the condition should be. If we have an extraordinary expense or repair, then those are, again, like a major overhaul. It's going to extend the life of that asset. Those we can consider to capitalizing or putting to the equipment value itself. So the journal entry, again, if it was an ordinary repair, we're going to debit repairs expense and credit cash. If it's a betterment or something that we think is going to extend the life of that asset, we're going to put it right to the asset, so debit machinery and then credit cash. Now then we can then sell these assets. So if we sell the assets, we have to do journal entries. And the journal entries are a little bit harder because we're going to hit a variety of counts. Cash is going to come in, But then we have to remove the asset and we have to remove the related accumulated depreciation. So if we take the asset off of the books, whoops, let me go back. It has a debit balance right now, so we're going to have to credit it. If we take the accumulated depreciation off the books, it has a credit balance right now, so we're going to have to debit it. And then these two here give us the net book value. So we compare that net book value to the cash, and if we receive more cash than we have on our books, we'd have a gain. If we receive less cash, we'll have a loss. And then again, that would have to be recorded. So we'll have 4 line items in that journal entry, assuming there's a gain or a loss. So then here's the rules. If the cash proceeds are greater than the book value, we have a gain. If the cash proceeds are less than the book value, we have a loss. If the cash equals the book value, there's no gain or loss. So here we have one. If it's just fully depreciated and we're throwing it away, we still have to take it off of our books. So we credit the machinery and then we debit the accumulated depreciation machinery for $9,000, and there's nothing else to write off. It's just done. Now, if we discard of it and it's not fully depreciated, we have to first get it up to date on its depreciation. So if we're sold it on July 1st, we've got 6 months of depreciation to record. So if we're depreciating it at $1,000 a year, and then 6 months over 12, so because half a year, so it's going to be $500 for that half year. So we debit depreciation expense, credit accumulated depreciation equipment. Then we take it off of our books then. So it has an $8,000 cost. It had $6,000 in depreciation. We just brought it up to $500 to bring it current. So that takes it up to $6,500. So then our net book value is $1,500, and we are just throwing it away, right? So we are not getting, there's no cash coming in. It's just being discarded. So then we would have a loss of that $1,500 book value. So a loss on the disposal of the equipment. Now we're going to sell it, so not just throw it away. So we still have to do that first step, bring our depreciation up to date. So in this case, we are selling it on March 31st, so there's 3 months. So if it's $4,000 depreciation a year, multiply that by 3 divided by 12. We're going to record $1,000 worth of depreciation expense, increase our accumulated depreciation by that $1,000. So if the balance was $12,000 at the end of the year, it's now up to $13,000. And then if we look at our net book value, it's $3,000. $16,000 minus the accumulated depreciation of $13,000 gives us a $3,000 book value. And that's exactly what we're selling it for, though, so there's no gain or loss. Now, what if we really get $7,000? So everything else is the same, except for instead of getting, what was it? $3,000 in cash, we get $7,000 in cash. So then our net book value is $3,000. We're getting $7,000. So we have a $4,000 gain on the disposal of that equipment. And our gain is like a revenue. It's money coming in, so it's a credit. Now, what if we sell it, same scenario, but instead of getting the $3,000, we get $2,500. So again, the net book value is $3,000. We're getting less than that by $500. Then we have a loss on the disposal of that equipment. And the loss is a debit, much like an expense or a cost. Okay, then we also could have natural resources. So say you work at an oil and gas company. They could have oil and natural gas natural resources that they're selling. Maybe you work at a coal mine. They're selling coal, or a gold mine. So then what do we, or a timber field, you know, you can have timber as a natural resource. So then what happens is these are natural resources that we are extracting from the ground and then selling for revenue. So then we handle this a little bit different. It's called depletion. And we take our cost minus our salvage value and divide it by how much we think we're going to be able to produce out of this well or this mine. So in this case, it's a mine, excuse me, of iron ore. So we paid $500,000 to get it. We estimate that there's 250,000 tons of iron ore in this mine. So we're going to, when we extract it, we're going to charge off $2 per ton. So we've got our $2 depletion rate times the tons that are extracted. So we're going to charge $170,000 in depletion expense. So we say depletion expense dash mineral deposit, and then it goes to accumulated depletion mineral deposit for the 170,000. So if we were to look on our balance sheet, we'd have a mineral deposit of 500,000 less accumulated depreciation of 170,000. So then our net book value would be 330. If we have that same scenario, but some of it is not sold, then we'll put it into inventory. So then if 30,000 of it remains unsold, we create an ore inventory at that 30,000, but the whole 170,000 still goes to the accumulated depletion because we've taken it out of the mine. So any type of natural resource would be handled that same way. Now, intangible assets, those are things that you can't necessarily see or touch, so they don't have a physical existence, but they do offer some sort of future revenue potential. They do have a useful life, and we do have a cost that's associated with them, only when we purchase them. We can develop intangible assets internally, but if we do that, we can't value them, only if we purchase them. So our purchase price could include what we pay, the legal fees, the filing fees, and then these are all examples of different intangible assets that a company could hold. Many of these you will talk about in your business law class, like patents, copyrights, franchise, trademarks. Goodwill is something you don't talk about in that, but goodwill is if you purchase another company and you pay more than the value of that company, you're recognizing that there's something intangible that you're paying for. So a patent is the right of the exclusive right of the owner to manufacture a patented item or use that process for a specified period of time. Copyright gives the owner exclusive right to publish music, movies, art, literature, any of that stuff for their life plus 70 years. A franchise you purchase, and then it gives you the right to sell that product under like the name like Subway or McDonald's or UPS or whatever. Goodwill, again, I said it's when you purchase a company and you pay more than their individual assets offset by their liabilities. So you recognize there's something more to this company than what is on their books. Then you can record that goodwill. Right of use assets is a lease. So again, you've got the rights to use this under contract. Leasehold improvements are improvements that you make to property that's not yours, but you decide to add value to it and you want to depreciate those over time. Software licensing, customer lists, covenants not to compete, other things like that. Research and development, that too is something that you have to purchase. You're going to expense those costs as you incur them. So you don't actually set, like if you create them, you don't actually set them up as an intangible asset and then amortize out. So those are really expensed as incurred. What ratios we have that go along with more of our long-term type assets is our asset turnover. So that's our net sales divided by our average total assets. Now that does include current assets though, but it also includes our long-term assets because it's our total assets. And then we would get, again, another one that's a times. How many times does it turn over? And it's something we can compare to ourselves or compare to another company in that industry to see how we're doing. Okay, so that is our long-term asset.